First of all, though, before I get into specific criteria, I want to talk about affordability, because this is such an important factor in commercial lending. You'd think it'd be easier to meet a lender's affordability criteria if they were offering you the lowest rates. It's going to cost you less, isn't it? Lower rates cost less, therefore it should be easy to qualify. That isn't the case, and that's because the lenders offering the lowest criteria tend to be the high street lenders, tend to be more risk averse, so they put all sorts of tests and stresses and buffers in there to de-risk themselves. That means that it gets more difficult to qualify for a high street loan. I'm just going to talk you through some examples to give you a little bit of a flavour for it. Now, the key factors that come into this are the repayment type. Is it capital and interest, or is it interest only? The amortization term. So that's not necessarily the term that you take the loan over, that is the repayment term that it is structured over. And a lot of people don't quite realise this. You can take a 10-year loan term, you are committed to 10 years, but the repayments are worked out over 25 years, amortised over 25 years, which means it's like a capital and repayment loan over 25 years as far as your repayment is concerned, but you're not reducing the balance of that rate. So at the end of your 10-year committed term, you're still going to owe some money. But that means with an amortisation of a loan over 25 years, the repayments are lower, therefore the affordability is easier. Bit complex, but I'll try and illustrate what that means in a moment. Then you've got the pay rate. What rate are you being charged? Really, really important. But when it comes to affording that, as far as the lender's concerned and meeting their criteria, they've also got to consider their stress rate. And that means that the lender's going to say, what rate are you paying? What do we want to add on top of that to protect ourselves as a buffer? And some lenders add no stress rate or very small, and others add darn big ones. So that has a big factor in there as well. And then the other thing is the ICR, their income coverage. So if your repayments are at the stress rate £100 a month, we'd like really to make sure that there's sufficient affordability there for £125, £150 a month. In some cases, £175 a month. So what they do is they stress that up again. So there's lots of levers in the whole process to cover their back in the case of voids, if you're an investment company with property that you're investing in, or if you're a trading company, to cover off any downturns in the business. So I'm going to give you an example of that now, so you can see why this is important. Because affordability can dictate which lender you go with. It can even dictate the LTV you borrow, because with some of the more high street lenders, because of their strict affordability criteria, whilst you're on a lower rate, you can only afford to borrow up to 50-55% loan to value. Whereas another lender might say, well, we'll go to 75% at a higher rate. Doesn't make sense, but that's the way it is. So you should see now, pop in your screen somewhere here, a chart. So if I just explain this to you. So firstly, we've got the lender type. That's the type of lender. Tier 1 high street, tier 2 just below high street, tier 3 specialist. There are tier 4s in my mind and tier 5s, but I'm not going to go there at the moment. And then you can see you see where they have appetite. Some are doing investment property and interest only. Investment property and own occupied. Some are only doing investment property. Then we have the amortization term. Your specialist lenders very often will amortize over up to 25 years, subject to the age of the applicants. But a lot of the high street lenders, they're only taking the terms up to maybe 180 months. That means the repayments will be higher, which means the loan is less affordable. That's the first thing that the high street lenders will do. Then is it capital and interest, or is it interest only? Interest only, way cheaper. And then there's the actual rates they charge, the stress test, and you can see here, stress test starting, some are stressing at around about 8%, others at 5%. And then you've got the ICR. What extra factor do they build in? If the repayments, the stress repayments are £100, do they expect to see £125, £135 income to cover it, or £175? And then on the right hand side, this is where it is interesting, that's the income you need to be able to afford a £500,000 loan with each of these types of lenders. So really the key thing to do is to look at that column, because if you go down that, we have a tier 3 lender at the top. So for a £500,000 loan, because of the way mainly because of their high stressed rate, you need an income, a rent, a profit, EBITDA, whatever you want to call it, of about £60,000 to afford that £500,000 loan. The next lender down, now this is interesting, this is a tier 2 lender. They're offering some great rates, but they're not overstressing everything. So you can actually get with that lender with only £46,000 worth of income. So you'd think, why would they offer you a lower rate if they're taking a greater risk on affordability? It's just because they've worked out that's where they want to be and other lenders haven't got there yet. Tier 1, typical high street lender. You'll notice here we're amortising over 180 months. It's a 180 month repayment term. That has an impact. The rate you can see is really low. The stress rate, not too bad, 5.5%. Sometimes it'd be less than that, but look, they want a factor of 175% coverage, where other lenders are only looking at 125. So typically, to get that high street rate, you're going to need an income of about £87,000 for your £500,000. That's what you're going to have to show. Another tier 3 lender, £53,000, similar to the one at the top. But then at the bottom, we have got interest only. Now, most high street lenders don't like interest only. They just don't want to do it. Some of the tier 2 lenders look at it. Tier 3, yes, they will consider it in some cases. But if you look at the affordability that you need to get that £500,000 loan, you can see it's £27,500 on an interest-only basis. So I hope that just gives you a bit of a feel for how different lenders look at different types of scenarios. But around affordability, there's a huge difference there, from £27,500 up to £87,500 needed to support a £500,000 loan. So which lender we can get you with will depend on your profits, and that could dictate the rates. Okay. What I should say at this point is, if you're an owner-occupied business, it's not just your profit, because if you've got a set of accounts showing you're making £100,000 a year, and we present that to a lender, but they also see that you're taking dividends out of £100,000 a year, then the business has no income to be able to support the loan. So your dividends are really, really important. So at the start of any application, have a chat to us about it, please do, because we need to talk about the whole picture, your dividends, your income, your outgoings, and what we can do in some cases is evidence that you don't actually need those dividends. You take them because they're there, but you don't need them to support your personal outgoings, so we can add those back in. If you already rent a property, we can add that rent back in if you're now moving into a purchase property. Anyway, let's just very briefly talk about owner-occupied. This sector has been strong throughout COVID, with rates from around about 2.25 plus base at the moment. We find we're placing most cases which come our way, and we can get LTVs up to 75% LTV. But the sweet spot, really, if you want to get into those lower rates, is probably more like 65% loan to value. As I say, the most critical factor is affordability, but especially for owner-occupied businesses, demonstrating how the business has recovered if it has suffered poor trading during COVID, if you've taken a bounce back loan, if the business has been propped up by furlough income and things like that, because those are things the lender's going to say, well, that won't be there in the future, so how's it going to perform without that? It's tempting as a business owner to say, well, look how well it was doing 2 years ago. Yes, we've taken a hit, but the lender's going to want to say, yeah, okay, we want to see that you're demonstrating you're getting back up to those figures. So really good MI is important. On any trading business, the lender's going to say, right, let's have your accounts. Let's have recent accounts. If your accounts were prepared some time ago, let's have management accounts and MI, bank statements, etc., etc. All right. So that's owner-occupied businesses, but there's some great deals around, and we're having a good time with owner-occupied businesses, generally speaking. Let's move on to investment, because that's been the area that's been really, really tricky over the last few years, with lots of lenders pulling out of various sectors, but now starting to ease their way back in. Firstly, we'll talk about residential blocks of flats, for example. That's not been too bad, actually, and both the high street and the specialist lenders generally like these. The challenge with the high street lenders has been getting the rental yield to stack up to meet the LTV demands of the borrower, because as I explained earlier, if you've got a lender who says, yes, we love residential blocks and we'll go up to 65%, But because the yields on residential doesn't tend to be as high, once you put it into the affordability calculation, you're probably getting closer to sort of 50-55% with some of these lenders. So yes, they love them, but you can't always get what you want. However, we've got lenders with easier affordability criteria, and I mentioned one earlier on, where we're getting rates around about 3% plus base, capital and repayment, in some cases even interest only, and they can get up to 70, even 75% LTV at a push. This is new criteria that's come in fairly recently, so that's really, really competitive on the residential blocks. Looking now at mixed residential and retail, i.e. flats over shops, before Christmas, there was a bit of a move to 70% LTV by one of our lenders, and they were getting a little bit more comfortable with this scenario of mixed flats and shops. Convenience stores did okay, but if it was anything other than a convenience store, it was, you know, they were very, very wary. However, we now have lenders accepting this type of property with even restaurants, bars, and that sort of activity going on the ground floor, with residential above at rates between 3.5% plus base. So semi-commercial is looking pretty good at the moment. A real important factor in determining the rate and the lenders is what percentage of the property is commercial and what percentage is residential, i.e. how much of the income is coming from resi. So if it's a predominantly residential property, maybe 2 floors with flats above and 1 floor with a shop at the bottom, then you're into really good semi-commercial with a high residential income. If it's more the other way round, yes, there's still lenders that will do it, but they might price the risk a little bit differently because they're more reliant upon that retail or restaurant income that's coming from the ground floor. So look at LTVs at 65% for these lower rates, but higher is available, to potentially up to 75%. Now, this is an area which has been really tough. Leisure, pubs, restaurants with no residential element. Really, really tricky in the past. But we are now seeing lenders to come looking back at these, and we do have one lender that is looking at them positively with rates of probably 3.5 to 4%. However, they are going to look very, very closely at the quality of the tenants. So if you're buying a pub to rent it out, this isn't owner occupied I'm talking about, this is if you're buying it as an investment, a pub or a restaurant, they will look very, very closely at the tenant. If you've got some residential income, great, that makes it easier. But don't be frightened to try those and talk to us about those sort of properties. But single asset, tough, but it's got to be a really good tenant. 65% LTV is probably the norm, but we'll push for higher. And I think this is an area which we're going to see ease as the months go by. I should add that where we have pubs, restaurants, no residential element, but with a mix of tenants, so the risk is spread. So it could be a pub, an office next door, there could be some storage there with multiple tenants. That in itself also helps to spread the risk. And in some cases we've even got 5-year interest only deals available, circa 3.5%. But for these lower rates, generally you're looking at loans of £350,000–400,000 upwards. That doesn't mean to say we haven't got lots of lenders who will do below that, but the rates aren't quite as keen. Commercial industrial trading estates. These come up from time to time, and it's a bit of an odd one because some of the high street lenders really love them and some don't. So provided we can get the yield to support the LTV that you're looking for, there's some really good rates going in the high street under 3%. And generally speaking, on these sort of trading estates, the yields do tend to be a little bit higher. You sometimes see them at around about 6.5%, but I think 7, 8, 9 is pretty standard, and we're seeing some even well into the mid-teens. So those seem to be good investments at the moment. Land, well, okay, if you've got a plot of land, that's always been quirky. It's always been unattractive. Land with planning is different, but then you tend to be looking more at development finance. But just a piece of land to secure a loan against, it can be done, but there's not a lot of choice out there. We're very much into the specialist sector. Before finishing, I just want to quickly talk about adverse credit. The lenders you'd want us to approach are going to be looking for clean credit. But if if there is some adverse in the background, if it's historic, if there is a good reason behind it, tell us at the outset, because we can place business if there is a good story and we can evidence that that story is true. And heavier adverse, well, if you're coming out of a really bad time and you're looking to get into property either as an owner occupier or as an investor, it can be done, but the rates are higher, so we need to look at each one on its merits. Finally, loan size. Often people will say, I hear you can't do small loans. That's not the case. We can still do loans under £100,000. However, if you're looking for the really good rates, then it's probably going to be a little bit higher than that. On investment property, I would say you probably need to be up to £350,000 and upwards. But there's plenty of tier 2 lenders and high street lenders doing loans for £150,000, and if it is less than 100, that can be placed as well. Just there's a little bit less choice. Investment property, there's probably less choice on the investment side for lower value properties, but the high street lenders will look at under £100,000 without too much of trouble, provided all the affordability stacks up and the whole picture is good. So that's a real quick whistle-stop tour through what's going on in the commercial sector right now. If you'd like to have videos, please do like them and subscribe and share them. And of course, get in touch. Happy to chat through any scenarios you've got. Call us at promisemoney.co.uk. Thanks for watching and talk to you soon.